Welcome to The Explainer. So let's just jump right into this. Have you ever noticed how the financial advice you actually need completely changes depending on how much money you make? Seriously, what works perfectly when you're bringing home your very first professional salary is absolutely not the same playbook you need when you're a high earner trying to dodge a massive tax bill. Today, we're opening up the Financial Strategies Playbook. We're going to take a journey up the modern income ladder, and we'll break down the exact moves, the mindset shifts, and even some crazy wealth-building loopholes for three really distinct income brackets: $50,000, $100,000, and $150,000 and up.
But right off the bat, to really understand this, we kind of have to address the elephant in the room, right? And that's financial anxiety. Look, back in 2016, the median household income in America was right around $59,000. That meant a $100,000 salary made you feel pretty rich. I mean, you were 40% above the median. But today the median household income is pushing $84,000. That means a six-figure salary is now barely 20% above the median. So if you've been sitting there wondering why 100 grand just kind of feels fine and barely enough these days, you were not crazy. The goalposts have literally moved, which is exactly why our strategies have to adapt.
All right, let's start with Tier 1, the $50,000 income, where the name of the game is playing defense. When you're bringing home 50 grand, your actual take-home pay is right around $3,400 a month. And that has to cover your rent, groceries, getting around, and hopefully maybe a little bit of savings. Your margins are thin here, so every single dollar needs a strict job. To survive, and honestly to thrive at this level, there is a very specific sequence of 5 priorities you need to follow. First, you have to kill high-interest debt. Second, capture your employer's 401k match. Think about it. If your company matches 4% and you make 50 grand, that's $2,000 of completely free money. This is a guaranteed 100% return on your money. You literally will not find an investment on planet Earth that beats that. Third, build up a 1-month emergency fund of roughly $3,400. Fourth, start funding a Roth IRA to lock in tax-free growth while you are still in a lower tax bracket. And fifth, you need to properly value your time.
Let's double-click on that very first step for a second. Debt. High-interest debt is just the ultimate wealth destroyer. The average credit card balance in America right now is over $6,000, which costs well over $100 a month in interest alone. When you only take home $3,400 a month, losing $100 just to tread water, that's the difference between actually building savings and being stuck living paycheck to paycheck. Oh, and you have to beware of those buy now, pay later apps like Klarna or Firm. They seem so harmless, right? Like, oh, it's just 4 easy payments for those new sneakers. But if you stack 3 or 4 of these up, you are quietly committing hundreds of dollars of your future income. It traps your cash flow before you even get paid. Now, that final priority at the $50,000 level is understanding the value of your time. If you take $50,000 and divide it by a standard 2,000 working hours a year, your time is worth exactly $25 an hour. Whenever you are trying to decide how to spend your weekends, you need to keep that number in your head. Because while driving for Uber or doing DoorDash is totally fine, the highest return on your time usually isn't a weekend side hustle. It's actually getting a credential or a certification that permanently bumps your baseline salary from 50 grand to 60 grand.
Moving up the ladder, we hit Tier 2, the $100,000 income. This bracket is all about automation and optimization. If you've made it here, seriously, applaud yourself. Your basic survival problems, they're mostly solved. You can probably buy groceries without tracking every single penny, and a random car repair isn't going to completely ruin your life. And because of this, a fascinating psychological shift happens. Your entire financial strategy pivots from pure defense to automation. See, at $50,000, you're constantly asking, am I going to be okay this month? But at $100,000, the question totally shifts to, when am I done? You stop worrying about survival and you start worrying about financial independence. But to actually answer that question, we need a flawless system. And that system is called reverse budgeting. Honestly, it is the ultimate engine for wealth creation at the 6-figure level. In fact, a huge focus of our explainer today is how reverse budgeting easily saves you $1,000 a month. So what is it? Reverse budgeting simply means setting aside your savings first, immediately when your paycheck hits your account, before a single bill is paid or any money is spent. You automate it entirely so you never even see the cash. Okay, let's look at exactly how reverse budgeting effortlessly tucks away nearly $1,000 for you every single month. If you make 100 grand, your monthly take-home is roughly $6,000. By setting up an automated target of 15%, which is $900, that money is instantly routed straight to your investments before you can even touch it.
You're then left with $5,100 to spend completely guilt-free on literally whatever you want with zero line-by-line budgeting required. Boom! You basically just saved almost $1,000 a month on total autopilot. And over 35 years, just this one single automated habit compounds to over $2 million. Now, at the $100,000 level, you also unlock some new wealth vehicles. And this one is arguably the absolute best kept secret in personal finance, the Health Savings Account, or HSA. But here's the trick. We aren't using it just to pay for everyday medical bills. We're treating it as a supercharged retirement account. Why? Because it is triple tax advantaged. Your contributions are tax deductible going in. The growth is completely tax-free. And any withdrawals for medical expenses are tax-free coming out. Here is how this incredible loophole actually plays out over the decades. Step 1, you max out your HSA right now. Let's just say you invest $4,000. Step 2, when you eventually get a medical bill, you do not use the HSA to pay it. Instead, you pay out of pocket with your regular checking account. But, and this is key, you save the receipt. You do this for decades. Because you left that initial $4,000 invested at an 8% return over 30 years, it compounds to over $40,000. Then, step 3, when you hit retirement, you take that giant stack of decades-old medical receipts, hand them to yourself, and withdraw those funds from the HSA completely tax-free. There is literally no time limit on reimbursement. It's just pure financial magic. Now, remembering that question from earlier, when am I done? Well, here is the exact formula to calculate your personal finish line. Take your annual spending and multiply it by 25. This is based on the famous 4% rule. So if you spend $60,000 a year, your financial independence number is $1.5 million. And this brings us to a really vital truth. Your retirement date depends entirely on your savings rate, not your raw income. The more you save, the less you're accustomed to spending, which dramatically lowers the total amount you actually need to retire.
All right, stepping into Tier 3, the $150,000 plus income. Here, the focus shifts entirely to tax efficiency and capital preservation. At this level, the game completely flips. Your largest expense is no longer your rent or your mortgage or a car payment, it's taxes. You're sitting in a 24 to 35% marginal tax bracket, so every single dollar you can shelter from the IRS exponentially increases your compounding wealth. For high earners, standard limits just aren't going to cut it. While the standard 401k limit is roughly $24,500, if you work at a tech giant like Google, Microsoft, Meta, Amazon, you might have access to something called the Mega Backdoor Roth. This is a highly technical process that allows you to contribute post-tax dollars and convert them, letting you shelter up to $67,000 of your own money per year. If your company offers this perk, you are sitting on an absolute goldmine for building generational wealth. Beyond just tax loopholes, you also have to manage and actually preserve this high-level wealth. A really popular playbook for high earners suggests staying pretty aggressive, meaning 80 to 100% in equities when you're under 50. Once you're over 50, you shift gears to capital preservation, dialing it back to 60 or 70% equities. But listen, the biggest trap for high earners by far is restricted stock units, or RSUs. RSUs are taxed as ordinary W-2 income the exact moment they vest, regardless of whether you sell them or hold them. So the smartest play is usually to just sell your RSUs the very day they vest to avoid being overconcentrated in a single company, and then immediately deploy that cash into a properly diversified portfolio. So when you put it all together, the ultimate high earner tax play looks a little something like this. First, you defer taxes right now by maxing out a traditional pre-tax 401k. By doing this, you're saving $8,000 to roughly $9,500 in taxes this year, right while you're sitting in your peak earning bracket. Then you combine that with a backdoor Roth IRA. When you eventually retire, your tax bracket is probably going to be lower, which means you win on the front end with the 401k deduction today, and you win on the back end with completely tax-free Roth withdrawals later. You are essentially squeezing every last drop of efficiency out of the tax code. We've covered a lot today. We went through the survival defense for the $50,000 earner, the automated reverse budgeting that easily saves $1,000 a month for the $100,000 earner, and the hardcore tax shielding tactics of the high earner. But all of this leads to one final provocative question that I want you to answer for yourself today. What is your financial independence number? Seriously, take your annual spend, multiply it by 25, and write that number down. That is your finish line. Because until you know exactly where you are running, it really doesn't matter how fast you get there. Take action, map out your number, and start building your systems today. I'll catch you next